Good afternoon, everybody. Thank you so much for joining us this afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm very honored to be joined by Michael Knott, U.S. Director of Research for Green Street. A little bit of housekeeping before we start. I'm going to run through just a quick presentation, just kind of introducing Michael, introducing Green Street, as well as some of the questions that we've got teed up or that I hope to address in today's presentation. In addition, we ask if you have questions for Mike, please put them in the Q&A. We will try to get to all the questions as possible. We will be promoting this, publishing this. We're going to be, getting this out there a lot. So we obviously hope that you do engage with us. Just to confirm that you guys can see my presentation on the screen, introducing our webinar with Green Street. For those that don't know, Green Street's a very unique firm. Mike will go into the history of it, but for over I would say close to 35 years now, if not close 40 years, thank you, Mr. Knott, they provided some of the most insightful, unbiased, unparalleled research. They are a leading voice in the REIT industry. I'm a little biased. I did get the start of my REIT industry career on the trading desk here in Dallas for Green Street. I was there for about a dozen years. At this point, they cover over 130 publicly traded companies here in the US and Europe, as well as produce a variety of data talking about commercial property values and REIT market values. As I mentioned, very in-depth global coverage of the world of REITs, a very experienced team, average approximate tenure over 20 years. And one key note is that they are independent. No investment banking relationships. Green Street has an independent voice. And as I like to say, they can call a spade a spade. They are not afraid to share their thoughts on the industry. When you look at their track record, going back to 93 through 25, their buy recommendations have generated annualized total returns of 20%. And a key highlight of Green Street's research is this index called the Commercial Property Price Index, also known as the CPPI. And I know Mike will go in depth with that. To introduce our speaker, Michael Knott, a very close friend, somebody I grew up in the business with. As I mentioned, he is the director of REIT research at Green Street. He rejoined in 2019 after being the CFO at EQ Office. That was Blackstone's office portfolio spinoff. Mike has basically been across multiple sectors at Green Street, won Wall Street Journal awards back in the day, and came from Indiana University. The topic of conversations today, some of the questions that I hope that we do get through include such things as that fun topic, such as tariffs. And Mike, we want to talk about NAV, Green Street and the world of NAV and how that comes into play with REIT valuations. What about sectors you guys like and don't like? What about M&A? Is there any hope for M&A activity this year? Can we talk about particular companies or recent REIT IPOs? We have seen, several IPOs over the past year or two, including Lineage, Smart Stop last week, as well as American Healthcare REIT, which converted from a private to a public last year. We want to talk about the voice that Green Street has in the industry. As I mentioned, the CPPI index, the good old public versus private story and valuations. And basically, at the end of this, because of our audience and the wide scope of folks that are attending or will be watching this afterwards, what should the average investor think about when it comes to REITs? So with that, Mike, I'm going to stop sharing my screen. I'm going to let you, you work your magic. And why don't we hop into it?
All right. Thanks, David. Appreciate the very warm introduction and welcome. And thanks to everyone listening live and on replay. Thanks for the interest in Green Street, and thanks for the invitation. So a lot of really great questions and topics that you lined up. We'll try to cover as many of those as we can in our time. So thanks again. So I won't spend too long here, just some info about Green Street. David hit the highlights. We now cover, in addition to US and Europe, Canada as of last year. Very experienced team there with our colleagues based in Canada. And then we're going to be launching in Australia eventually later this year, which will be great. Very exciting. Green Street's grown in some different ways in recent years. News, and then also now toehold and real assets via some infrastructure work that a company we acquired does, IJ Global News and Events. So exciting times at Green Street. So it's been fun. Been here over, gosh, 22 years total, I think. So it's been fun to have a front seat at the company life cycle growth from very small company to something much bigger. And the voice in the industry has been something we care about. The independence you highlighted. Trying to really answer the right questions and be thoughtful and add value through thought leadership and great research is really the key thing that we go for. So from here on, David, let's just do it sort of as a discussion, and you can keep me on track for the topics you wanted to hit. So this slide is just a quick one on NAV. So NAV is a key concept that is a key part of REIT valuation that we've had in our toolbox for a very long time. We care a lot about high quality NAVs, and we've always taken great care in all the different aspects of creating NAVs for all the companies that we cover, about 85 in the US. And I think it was 50 in Europe and 14 and growing in Canada. So we do care a lot about NAVs. It's an important valuation benchmark. There's public market, private market benefits to having a great read on what asset values are, what NAVs are. We can talk more about that. We care a lot about private and public market real estate. We really believe that we have a great voice in both markets, and that makes commercial real estate pretty unique, that there are really valuable signals emanating from the public market that are widely and highly applicable to those who do direct private real estate investing only. So NAV is basically net asset value, mark to market assets, and whether it's real estate and any other assets on the books, and then less mark to market liabilities. We care a lot about marking liabilities with varying interest rates. That matters quite a bit. So at the end of the day, we devote a lot of resources to updating, maintaining, being very thoughtful about NAVs, cap rates, the components thereof, NOI, making sure we get a good next 12-month NOI estimate. So all those things are really important in our NAVs, and our clients care a lot about NAVs. Now, arguably, the public market has become more focused on, interested in the earnings profile of the REITs and the REIT industry, as you've had more passive investors, more non-REIT dedicated investors come into what's now a much larger industry, right? We have, what is it, David, 30 or so companies that are in the S&P 500 versus 25 years ago that was zero. 20 years ago it was probably a couple. So nonetheless, NAV is still really important. So on the left side of the chart here, you see the green time series goes back about 25 years. It's the unlevered version of NAV, premiums and discounts across our entire coverage. So you can see varies quite a lot. Optically, the average there, approximates parity. So over longer periods of time, REITs trade around NAV parity. But you can see there are obviously periods where big premiums, big discounts. And why is that? We think, again, the public market has a lot of value in terms of predicting what will happen or what is likely to happen with private market valuations. And so you can see that relationship there. So the tan bar is subsequent property appreciation in the private market for each signal data point on the listed side, GAV premium or discount. So it's a really great tool, whether you're a public investor or whether you're a private investor. And we believe very strongly that all stripes of commercial real estate investors ought to care about this signal, it can help their performance. So currently we're a slight discount to GAV, and we can talk more about why that is in a second.
Well, I would like to ask the question, obviously, because of the fact that we've seen so much volatility over the past couple of weeks. I don't want to get too far ahead regarding tariffs and everything. I know we're going to get into it. But is it too soon to say that there has been an impact on NAVs because of the movement we've seen in the past 2 weeks, or with this potential overhang of tariffs in the REIT industry?
That's absolutely the question. And I think in some ways the real question in that question is what's the outlook for the economy and what's the outlook for interest rates? A lot of times folks ask the tariff question when I think they really want to know the answer to those two questions. And for certain industries, of course, industrial, for example, the tariff aspect is really, really critical. But there are a lot of macroeconomic implications of the tariff question. So just to finish on this slide, obviously a lot of sectors vary widely on whether they're priced at premiums or discounts to NAV or GAV. Let me skip ahead.
Well, let me go back one.
Let's go ahead. Let's do your tariff question. So I think we like to look at things a lot of times on an unlevered basis, right? So you can see in this chart, and we've published this a couple times in the last few weeks. This looks at enterprise value change by sector since April 2nd and compared to the S&P 500. Those are the bars. The light green is the effect of financial leverage. So you can see the equity returns basically by sector by looking at the totality of each bar. But the enterprise value aspect gives a good read on property values, which was your question. So all the way to the right, you see as of last Friday, the change was about -5% on average. So we think the public market was roughly signaling that since April 2nd, the outlook for commercial real estate pricing is about down 5%, give or take. And again, quite a bit of variance, a little bit of variance across property types. And then you can see the totality of the weighted average REIT bar is worse than the S&P. So again, we have underperformed the S&P 500, sort of a recurring theme, unfortunately. So since April 2nd, REITs on an equity basis have underperformed the S&P. Rates have been a little bit all over the place, but up quite a bit from, at one point, I think post April 2nd, the 10-year was 4%, maybe a tad under. And now we're back to 4.3, which is about where we started on April 2nd. So anyway, things have been bouncing all over. So yes, the answer to your question is, yeah, there is, we think, a negative implication to property pricing from the tariff question. And we can come back to this in a minute, but I just wanted to show this slide as well. We reduced our GDP outlook with our tariff report, our second tariff report, I should say, last Friday. So employment GDP outlooks, we think, are lower. Who knows what will happen, right? The odds or the range of outcomes is pretty wide. But in short, that's sort of the quick answer to your question. So we could go to whatever you want to go next.
Yeah, I want to go back to the first slide, but as I'm thinking about this, we have four companies that announced earnings in the past day or so. All have maintained guidance. But if you take it outside of REIT land, one thing we noticed was United Airlines, in their earnings press release, again, I know it's not REIT, but I'm just throwing it out there. United put out dual guidance in their earnings press release. If there's a recession, if there's tariff impact, our guidance is X. If there is no recession, no impact, tariffs, our guidance is going to be Y. Do you think some of the REITs might start putting out dual guidance as well, potentially?
It's possible. I'd be surprised, but maybe. Prologis yesterday talked quite a bit about different scenarios that they looked at internally. They didn't really change their earnings guidance.
I saw Hamid speak last week in New York at NYU, and the topic of uncertainty was spoken by every single REIT executive. Sure. But
Right.
every single guy had said, we can't make an outlook on guidance on something that was announced 5 days ago.
Right.
I can't
Right.
tell you our
Possible.
FFO has not changed since this happened. Our dividend hasn't changed since this happened. And you expect me to tell you what this looks like 6 months from now? We don't know because there's just so much uncertainty that's out there.
Right. Correct. Yeah. No, that's right.
Can
But
you go back? Can you go back to your
one thing to
NAV
add on
guidance?
to that though, the one certainty from the uncertainty is that decision making is likely to be stalled. So there are, we think, pretty clearly economic impacts from that, and so that's why a large part of why we went ahead and reduced our GDP outlook and employment growth outlook, as those stalled decisions should have some negative implications for the economy.
Can we go back to your first slide? I wanted to ask about the sectors and the NAVs that you had there. So I guess from a very high level, it obviously jumps out the premiums that both senior housing and skilled nursing are at compared to obviously the other end of the spectrum with lodging, storage, and life science. Why is senior housing and skilled nursing trading at such strong premiums right now?
Yeah, well, the outlook for senior housing is really outstanding. I have a slide we can share in a minute that shows a scatter plot of NOI growth by sector, both looking back and looking ahead. And senior housing just has a terrific outlook, exploding demand from the right demographic of 80 plus. Affordability is pretty good. Still, recovering from the COVID downturn, and exploding upward into just a golden age of demographics that developers and that industry have been waiting for 20 years, right? I think the NOI CAGR we have for the next 4 or 5 years is still double digits. So the public market rightly anticipating really strong internal growth there, but also we just wrote a report a couple days ago on Welltower and the really unbelievable run that stock has been on, and just the virtuous cycle to epitomize all virtuous cycles in terms of giant premium to NAV, signaling very notable cost of capital advantage and deploying that advantage into robust acquisitions and maintaining balance sheet health via equity raises, and a really great management team and story that people have really adhered to in the last few years and reflected in a really strong valuation. Skilled nursing is one where there's always stroke of the pen risk, but the yields are typically high in terms of cap rates and other sort of indicators of value that tend to be high in the private market. And the public market oftentimes will say that is really attractive, so we're going to bid that at a premium. So both sectors, the outlook for private pricing is pretty good, as implied by the public signal.
Can you
So
talk
those
about a
are
couple
some
of
of the rare
sectors on the
sectors that trade highly. What?
you talk about the other end of the spectrum, those that are trading at the massive discounts and what's going on there too?
Yeah, so the overall the average REIT trades at a slight discount to NAV. I want to say it's around 5%, maybe a touch below that. So the average signal coming from the public market is a little bit bearish on private pricing, but not too bad. With where we see the relationship currently between private market pricing when we run cap rates and growth through an IRR model. This is a tool we use quite a bit. It looks like private values are between 5 and 10% expensive, which roughly jibes with the two things. One, the public signal we're talking about here, the overall public signal, and then also that sort of 5% signal since April 2nd we talked about a minute ago in terms of market's reaction since April 2nd. So on average, the average property type is probably a little bit pricey, and so you see that reflected here with a number of sectors trading at either small, modest, or bigger discounts. So there's quite a few sectors that have traded at pretty large discounts. You see some of the ones at the bottom there: lodging, cold storage, life science, more recently trading at a very large discount to private pricing.
All right, let's jump into CPPI.
Okay, so this is a Green Street tool that basically just combines all of our cap rates, NAVs, asset value data into a tool that can be easily quoted and used. We give this out for free to media. So it basically tracks all asset values in our coverage over time. And so you can see it benchmarked to 2007 peak. We went up a lot and then we came down a lot, and came down from the 22-23 peak when interest rates then went a lot higher. Property values came down 15 or 20%, and then we've gone back up a little bit here recently, and you can sort of see a little bit of that here in this chart that shows since peak by property type. So we're down 18% or so is the number shown here. So pretty wide range across property types.
Is there a from inception chart that exists of this as well?
Not that I have offhand. You could see here it goes from, I don't know what the index value there would be in 98, but you could do the math. I don't have the math, but you could do the math.
Well, on a sector by sector basis, I remember obviously this being a Mike and Peter special way back in the day, and to see how this has evolved. But as you said, that next slide, when you look at it from 22 peak to current, it gets the hamster wheel on me spinning like, well, what does this look like since 98, 99 to today? How has ground lease values changed over the course of 27, 28 years, let's say?
Yeah, it would be interesting. We have other ways we could look at that too. Total return values, both public and private, you could look at. So there are ways you could also answer.
And by the way, thinking of guys like Professor Morris that are on the call here, think about how many of these sectors didn't even exist back in 2000, right?
Correct.
We didn't have cell towers back then. There was no such thing as single family rental. So this just shows you the evolution of the REIT industry as a whole over the course of time.
Right. I'm old enough that I played a role in initiating coverage for us in both data centers and life science over different years. So, to your point.
Yeah, back then cars were just invented, I think.
Thanks, Prof. All right, Mike, go ahead.
Can we mute our lines, please? I'm kidding.
Seriously. All right, go ahead, Mike.
No, I think we're good. So we talked about the economic forecast. Here, going back to this slide again, what I didn't touch on is so this is the enterprise value and equity change since April 2nd by property type. You mentioned Peter Rothman a minute ago. He and I wrote this report that we published last Friday. And the circle here is each sector's change in 29 NOI so in that report, we cut our GDP and employment forecasts. All the sector heads cut their market rev path forecast, which is our way of looking at fundamentals, market rent and occupancy. And then they also trimmed on average NOI forecast a little bit, mostly 25 and 26. But we wanted to look at the 29 change, and so you can see that here as sort of a companion to what the public markets vote was. So in almost all cases, the public market moved more, which also reflects not only NOI but also the outlook for interest rates and so on and so forth. So obviously, folks are scared about the impact of tariffs on rates, and so I touched on this a minute ago when I mentioned the 10-year, but the real interest rates have gone up, which is scary. That's a negative for all assets, and we've gone up. Germany, for example, has come down. So and the dollar index is down, I don't know, maybe 10% year to date or something like that. So I think there are reasons to be scared of what's happening in terms of the rest of the world's reaction to the tariff chaos, if you will, and will that negatively impact the U.S.'s the perceived stability and security of investing capital in the U.S., whether through 10-year treasury or equities. So a lot of things moving around in the background here.
Well, I want to touch on a couple of points here, and this is great. Obviously, again, going back to the NYU comment, listening to Owen Thomas, CEO of Boston Properties, and some of the other guys last week, with U.S. representing 70% of the global commercial real estate market as a whole, it's going to be a part of that global allocation, no matter how you spin it, especially for the sovereign wealth guys. And so we're still going to be the place where all these guys are investing. But Mike, my question to you, since you guys have, and again, I'm not asking for specific firms. I know you can't talk about any of that, and I wouldn't ask you. But what's been the general response from the readership and the following base of Green Street since you guys have put this stuff out? You guys are talking to management teams, institutional investors, sovereign wealth funds, insurance, pension plans. Your subscriber base is very diverse and dynamic. So what's been the overall feel from the investors that have been reading this over the past couple of weeks? Do you hear doom and gloom and fear, or is this we're being proactive? What's the response been?
I'd say just it's more in the realm of uncertainty. I don't think anyone necessarily has a better crystal ball where to say, oh, you guys are too bearish, or you're not bearish enough. So I think folks appreciate the thoughtfulness and the timeliness and trying to put some thoughts and changes out there. But I think uncertainty is probably the word of the day. And so there are probably other scenarios where folks might have stronger opinions about, oh, that's too much or that's too little. But I think the uncertainty is almost as high.
Let me ask you a more blunt question. Does this give an excuse to all the REITs to miss their earnings guidance for this year? Does this give them an excuse to cut dividends potentially because of this uncertainty and overhang? Or do you think this is just a blip on the radar and this will go down as another cycle like housing crisis of 08, 09, a COVID, a 9/11, we're going to bounce back from this?
We'll bounce back, whether folks, use that as reason to cut guidance or dividends or anything. Maybe. It definitely affects the rest of this year for sure. So,
I think it obviously, if you're a lodging guy, again, because I heard Leslie Hale talk about this last week, they are seeing impacts of tariffs, travel slowed down, DOGE cuts, again, not tariff related, but we are starting to see a trickle down in the economy already.
Yeah, lodging 100%. We saw industrials probably arguably one of the more affected sectors, but long lease terms. So as you mentioned, we had 3 industrial REITs report earnings and didn't really change guidance. So I think it varies by sector, right? So lodging, yes, there will be impacts to guidance probably. If not now, maybe later. The GDP change alone, plus you almost can't have a negative enough outlook for travel to the U.S. now, given the rhetoric and just the distaste that folks have, I think, all around the globe for what's happening right now. And I think that number, often already low base, was, I think looking at like down 20% year to date or something. So yeah, lodging, of course. Senior housing, will there be an impact? No, not really, right? At least not visibly, not directly. So it depends.
Well, we're at the halfway point already, Mike. It's amazing how quickly time flies. If anybody has
that means
questions,
I'm talking too much.
Huh?
So that means I'm talking too much.
You're doing great, man. I'm getting so much stuff here. If you have questions, please put them in the chat box. We will try to spend some time getting through investor questions. Let's go on to the next topic, Mike. What do you say? Let's go on to the next slide.
Okay. I'm going to circle back to this to the extent folks are interested in the slides after whatever. This is our market rev path forecast. So, but the key takeaway there is we still see overall good fundamentals for most sectors looking ahead. We're still seeing growing fundamentals. That's partly because supply is fairly reasonable. Again, it depends by sector. But in some spaces like strip centers, we have historically low supply. Mall is low. MH is always low. And other places, we're probably going to need to bring our supply forecast down. We just did that in a really good industrial tariff report that Vince, our sector head, wrote on industrial and changed some forecasts, including supply. So I think starts in some of the relatively higher supply sectors will probably come down, just given the uncertainty, given the outlook for higher replacement costs with tariffs and immigration policies as well. So that's this slide. We had published this report earlier in the year in terms of what could happen to construction costs if labor costs change by different percentages. So not an immaterial increase in replacement costs due to the outlook for higher labor costs, not to mention steel and other key inputs into construction likely to go higher as well. So I think overall replacement cost outlook is up, and that probably means good things for supply in terms of lower new supply, which means good things for fundamentals and therefore NOI growth. This is the NOI slide I touched on earlier. So scatter plot of historic NOI growth by property type against the outlook. And so you can see senior housing literally off the chart for the y-axis for the outlook. A lot of sectors kind of in line with history, which I guess isn't that surprising. But you can see variance, life science and storage, couple sectors that have had really good results that have a more pedestrian outlook. And so there's a lot of stories in this chart. So it's interesting. I really like this one. I don't know, anything you want to ask about here?
It's a great chart. I mean, this is what I love when I do my posts and all this stuff. It's pictures like this that just jump off the page. It's so shocking because you look at that previous slide about manufactured housing and the fact that, it's really not impacted by this. There's just not enough supply, but yet the NOI growth is, again, almost off the charts here, looking at where it's going. Sam Landy, basically last week, he's the CEO of UMH, he spent his time on the panel doing a promo for why to buy UMH. We just had our best quarter in history. We just raised our dividend and our stock is down 30%. And I think that's a really interesting takeaway because you look at all these guys.
Yeah.
Everybody's stock has taken it on the chin over the past couple of weeks. And so this is really interesting to see how really solid NOI looks, again, on a historical basis.
Yeah. And MH, so historically, right, MH and self-storage were probably two of the best performing property types, private or public, over a very long period of time. And now the outlook for MH is still good, but not quite as good. And self-storage is notably lower right now, really suffering from the lack of moving activity from higher mortgage rates. So storage hopefully will come back. And by the way, those two property types did so well historically, also in part because the CapEx profile is pretty favorable compared to a lot of property types. So that's something that Green Street historically has put a lot of energy into. But we historically really liked MH and self-storage, and those were one thing we got right over the decades was being focused on CapEx, like maniacally focused, and really caring about low CapEx property types, and MH and storage definitely fit the bill there. Although storage CapEx has gone up a little bit over time, but
it's almost like Mr. Zell knew what he was doing back in the day, huh?
Yeah. This analysis we do of private real estate pricing versus bonds, constructing an IRR. We publish this all the time. So we look at real estate IRRs, unlevered versus bond yields, compare that historically. We have this great proprietary time series that was on the last page of forward-looking real estate IRRs at any point in time. And then we compare that to bond yields, typically corporate BAAs. That's the chart on the left. And the spread's a little tighter now. Real estate IRRs are usually, call it 180, 190 bips higher than BAAs, and currently that spread is only 100 bips, so that's a negative signal for real estate values. And then, as I mentioned earlier, the signal from the REIT market is slightly negative. So again, we think the outlook from here for private pricing is down by a little bit. Won't spend too long here. This is just us looking at REIT betas through the lens of interest rate changes. We found that REITs have become more interest rate sensitive in recent years since rates went up quite a bit, 22, 23. And so this is cool because it shows by sector the increasing sensitivity to changes in the 10-year from 23 to 24, and then so far this year. So a lot of volatility in terms of REITs relative to interest rates. So again, a lot of stories here. We could spend a lot of time on this, but I think it's pretty interesting to see, towers, for example, we used to think of as a really nice high growth sector, and now the growth has been dialed back a little bit. And so now it's a bit more bond-like. And so you see that with its, greater degree of interest rate sensitivity versus other property types. So that's interesting. Lodging toward the bottom, of course, in terms of rate change sensitivity there.
That makes sense, obviously, with the single family rental side and how those relationships work. That totally, jives.
So I know we're probably running short on time. Sectors we like or dislike, we show here. This is our sector allocation work. We do this for both private and public. We publish this monthly. We publish our track record. We tend to get this right more than we get it wrong, but there are times where we on net are getting it wrong. Last year was one such case, but we tend to like the sectors toward the top. From a public pricing standpoint, there are a few.
Treat me like I'm a person who doesn't understand this. Can you walk me through this?
Yeah,
This is like the money shot here. So can you walk me through this?
Yeah. So we go through a lot of work to calculate the private return. That was basically that IRR math I showed you on the couple slides prior. That was overall. This is by sector. So we build up private market IRRs at private cap rates with growth and long-term growth. And then we do the same for public, which is was what we're building to on this slide. But then we overlay public pricing. So GAV premiums and discounts. So a discount boosts your public IRR, a premium lowers it relative to private returns. So you see some of the bigger discounts in that GAV premium column are toward the top of the list here. Then we take out the impact of G&A, which varies a lot by sector, or can vary a lot, and then make some adjustments here and there for external growth, balance sheet risk, and some other things, and kind of get to sort of a low 7 average expected return. Again, unlevered. We like to focus a lot on unlevered return metrics and valuation. So these are unlevered with an average kind of around 7. So there you'll notice, there are several traditional property types toward the bottom. Industrial,
healthcare
it's a little
both senior
expensive.
housing and skilled nursing on this slide.
It's everything and medical office. So it's a real potpourri of all the property types.
One thing that jumps out, and this goes back many, many years ago, and I don't know if this is considered under the other category or if this is more of a company by company basis. I'm putting on my many years ago hat, thinking about, again, Mike and Peter and the Brain Trust in the corner office there. But Green Street used to do a really big deal about corporate governance. And way back in the day, they used to rank management teams. They would score them, experience.
We still publish that report every year, every summer. So we look at governance and comp. We started that in 2003, around the time of Enron and WorldCom and all that stuff. So we've done it annually since then. And so we track it pretty meticulously and grade every company, and we look at exec comp in that report too.
So that's a company by company, not on the sector.
It used to be a variable in our pricing model for our recommendations, but we removed it at one point because we found that it matters a lot when it matters, but then other times, a lot of the other aspects matter more in the valuation, and arguably some of the, if there's a low governance score, it could be reflected through a discount to GAV or a poor franchise value score or whatnot. So that may be what you're remembering.
Yeah, and one more bolt-on question, because something different today that we didn't talk about 20 years ago was like ESG and DEI initiatives. Does any of that stuff make up part of that GAV premium and discount these days, or is that not something you guys focus on necessarily?
We've written a lot of research on these things in the last couple of years. Danny Ismail is our co-head of our strategic research, along with Peter Rothman, has written a lot of sort of environmental type research and impact across markets and across property types. And so we've done quite a lot with that, but it's not, there's no part of that really that's impacting our governance scores.
I have one audience question in hand. So we will lock out 5-6 minutes for audience Q&A, obviously. What else you got for us here?
A couple slides just on REIT overall. So we do care about REIT earnings. We've thought for a little while REITs were inexpensive relative to the S&P. So we have this long time series of looking at REIT AFO yields, so inverse of a multiple, right, against S&P EPS yields. And when we do the math, the time series is really wonky because of the late 90s REITs. You couldn't give away a REIT, right, during the tech bubble. REITs got stupid cheap, as reflected there, and had a long period where the earnings yield compressed quite a bit. You see that in the chart. And then ever since GFC, really post GFC, REITs have traded at basically a lower yield, and currently that's a little bit it's a little bit less expensive than normal, and so it looks relative to history slightly appealing. So we've thought REITs were on the inexpensive side for a while, and I'm gonna share one chart that really gets under my skin quite a bit. The long-term return history of REITs is really a bitter pill to swallow relative to S&P 500. So the good news is there's a lot of performance gap to make up going forward. So I do think that bodes well for future REIT returns on a relative basis. And by the way, this chart would look similar, if we put the Russell 2000 or whatever, like almost everything's underperformed the S&P except probably the NASDAQ, because the tech component of S&P has done so well. So, but it's frustrating to look at this. So this is my challenge to all the REIT executives out there. Let's have this number be a lot better 10 years from now, 20 years from now. And investors deserve better returns than that. So it's a challenge, I think, to improve on that track record. And we've triple checked the Bloomberg numbers to make sure it's not incorrect. But no, I say that tongue in cheek, but yeah, it's difficult.
No doubt.
And then this was just our you mentioned this earlier, so recent like last 10 years of buy sell spread. typically positive. So that's it. So that's all I got.
So Mike, again, at the end of the day, after all this, and thank you so much for putting all this information together for us. As always, a wealth of information, and it's why Green Street's the best at what you guys do here. I will ask again with the last question on my little presentation to you. What should the average investor be thinking about when it comes to REITs looking ahead? We'll stay very short time frame for the rest of 25.
Yeah, I mean, obviously rate sensitive. So for the short term, REITs will represent a bet on interest rates, right? For better or worse. But over the long run, I think, REITs should approximate and deliver what real estate total returns would deliver. We believe that the REIT vehicle is really the best way to access real estate, commercial real estate for the average investor. I know that can be a controversial view among many in the private market that a REIT's not really real estate. In the short run, it's a stock. In the long run, it is a stock, but it's also in the real estate industry, so should approximate what real estate will deliver. So I think for the average investor in the short run, it's rates will matter the most, and obviously economic sensitivity. We haven't talked much about that, but lodging is obviously very economically sensitive, and senior housing is not. So between bets on the economy, bets on rates, that will determine the near-term performance most likely. And then in the long run, it's important questions about asset allocation, right? What's the right percentage of REITs that will optimize a given investor's portfolio risk and return, and REITs.
What's the answer?
Have a place. I don't have a number, but it's greater than zero, despite the chart showed with the returns.
Wow, way to go out on a limb there, Mike. Wow, holy cow, that's greater than zero. Okay, that's good stuff there. Before I get to the audience Q&A, I do have two questions for you, or really one question. What keeps you up at night these days besides your kids?
That's a good one. Yeah, I think just again come back to that uncertainty of what will happen. Will the U.S. Will we give up our reserve currency status? Will we become unattractive to the rest of the world as a place to do business, as a place to get an education, as a place to invest capital? Those things are really important, and I worry that some of those things might go in the wrong direction.
Will your former firm be the last company standing? Will Blackstone be the last one owning all of the REITs at the end of the day?
Oh yeah, you did ask about takeouts. I would say it'll be challenging to have a bunch of M&A or privatizations, but I bet we still get something, one or two, before the end of the year.
Okay. All right. So Alexandria did $1 billion follow-on offering in January 22 at $210 a share. Today it's at $78 a share. What do you think about that?
Life science had a really terrific run, and fundamentals got white hot, and investors were pricing in a continuation of that, and it's been a bit downhill since then. And obviously the equity returns there are magnified by financial leverage. So life science is maybe arguably the most interesting sector today in terms of what will happen, right? There's a lot of things swirling, NIH funding and drug price controls, and will there be AI automation of some of the R&D process? Historically, it's been a pretty resilient property type with a lot of growth drivers, biotech funding and government funding, and increasing dollars thrown at all those activities, and arguably great real estate and three key cluster markets. So what will the outlook be? If I recall, the private pricing outlook is, on the more negative side. The public market is sending a negative signal about that pricing. Is it attractive today in the public market? I don't know. It comes with a lot of risk about what the outlook is. So it's I'm going to be somewhat neutral on that one.
Thinking about Mr. Lit in the background and his thoughts on things as well. All right, let's get a little bit wonky analyst-y type stuff. So on your slide 16, you ranked cold storage at the top and you adjusted for a 1.7% G&A expense. The person says that G&A does not include the overall value of high separate payroll, resulting in lower NOI margin for somebody like Lineage and Americold compared to the REIT sectors. Would it not make more sense to apply a higher discount for cold storage?
I'm not sure I fully follow the question, but there is an ongoing bucketing question of because it's an operating business, right? So it's unlike most of the other property types we follow, and you could bucket some of the sales, marketing, G&A into the NAV, and then maybe have a lower quote G&A bucket. So there's sort of an ongoing question there, but it does cost a lot to run those businesses, and we try to capture it in any time we're doing any valuation work on cold storage versus other property types.
I'm guessing it doesn't cost as much to run as data centers, though. I think that's a safe assumption, right?
No, I mean the Digital and Equinix have quite a bit of cost, but I think cold storage is probably a bit more operationally expensive.
Tariff question. What tariff outcome is the basis for your economic projections? Or to put it differently, how much and in which directions would it change if the initial announced tariffs were to go into effect in around 3 months?
Yeah, that's a great question. We presumed, so the cuts we showed were, I don't think 100 basis points to GDP in 25 and maybe 40 bips in 26. We basically presumed some cutback from sort of the original round of tariffs, if you will, that there would be negotiations or rollbacks, but some would still be in place. So it was a very imprecise finger in the air of, well, it won't be the full tariffs that are in place now or slated to be in place. It'll be something less than that, but more than nothing. So if there were, I think in short, if there were a full round of tariffs, there probably would be, a great or an even greater threat of recession. But our outlook is for low growth, but not a recession, but obviously a wide range of outcomes. So that's a good question.
My last question for you, buddy. What would Michael Knott 2025 go back and tell Michael Knott of 2000?
Buy tech, right?
Buy the Mag 7. No, seriously, what would you tell yourself from your experience today? Like, what would you tell the future generation of leaders that want to get into real estate? What would be your parting message to those getting their feet wet?
Hard work, intellectual curiosity, building relationships, always trying to ask good questions and trying to thoughtfully answer them, diligent, getting details right. I think all those things matter.
Well, Mike, it's been a hell of an hour with you.
That's been
so
fun.
Much great information. I will say, as I mentioned in the chat, if anybody's interested in Mike's presentation, just shoot us a message. We'll coordinate getting that information over to you. We'll make an introduction to Mike's counterpart at Green Street that will have that presentation. But Mike, I can't thank you enough for spending your time with us, sharing your insights. Green Street, again, as a big voice in this industry, I know many people will appreciate a lot of your insights, especially both where we're at and where we're headed in the rest of this year. So again, from the bottom of my heart, next Tommy's Cheeseburger is on me when we see each other.
Perfect.
And thank you so much, buddy.
Yeah, thanks a lot. Great to see you. Thanks, David.
Thanks, guys.
Bye-bye.
Bye, everybody.